Hello and welcome to this special edition of India Development Debate. Former Finance Minister Palaniappan Chidambaram once said that if government has to walk alone on the path of growth, so be it. But at this juncture of our economy, can that be a solution at all? Can and should fiscal policy be the lone warrior for growth? This is a question that gains momentum a day before the wise men and women of the MPC take a call on interest rates. There is a clamour for monetary easing. Yes, we agree that inflation is inched up, but it's important to point out that inflation targeting is for a 2 to 6% band, and the 4% figure, unlike what many believe, isn't really cast in stone.
Indeed, we also know that RBI rate cut may not move the needle on private investment much, but it will certainly boost retail demand, which will help utilize excess capacity. On the other hand, some argue that the RBI may like to wait for fiscal stimulus from the government, but at a time when growth has plunged to levels of sub 6% and economic activity is crawling, avenue of stimulus cannot be just fiscal. It has to perhaps come from Mint Street as well. So shouldn't the RBI give up its inhibitions and sympathize with growth come tomorrow? Because the cost of inaction, we at ET now believe, will be very, very huge. We are discussing the RBI credit policy on the India Development Debate. I'm Supriya Srinath in New Delhi, and joining me in Mumbai is my colleague Sandeep Gurumurthy.
And we've got a power-packed panel for you on the show this evening. Two of the finest economists, Jahangir Aziz and Chetan Iyer, join us live on the show. We've got Shobhana Kamineni, President of the CII, representing industry's point of view, and we're also joined by R. Jagannathan, eminent journalist, with his point of view. Thank you so much, all of you, for joining in on the show this evening. I'm going to start off with you, Ms. Kamineni, the industry's point of view. Are lending rate cuts key to revival of the economy at this stage? Do you believe that a lending rate cut is key to economic recovery?
The short answer is that it will definitely help. I think that among all other regions, India, of its neighborhood, India has the highest lending rates. And if we can bring down interest rates, it will actually cut corporate debt, and this will kickstart new investments. Apart from the fact that it will, as Supriya said, we do need lower interest rates to kickstart spending, and by the public. They'll buy more homes, they're going to use it for white goods, for cars, for automobiles. So I think the short answer is yes, it will definitely be a big help.
Okay, let's take this across to Chetan Iyer. And Chetan, well, that's the industry view that yes, lending rates are very crucial to investments. I'm going to ask you the first question to set the context really. Q1 GDP growth at 5.6%, that's the lowest in 6 quarters. Industrial growth for April to the July period is at 1.7%. Compare that to a 6.5% on a year-on-year basis. Current account deficit at 2.4%. The stakes have never been higher for monetary policy than now. Will you agree?
Well, I think monetary policy has largely done its job. So honestly, if at all we're talking about another 25 bips or so, and that's not really the key to recovery right now. The recovery has been held back because since 2013 second half, India has faced problems in terms of two key sources of demand, which is exports and consumption. So while until 2015 we had the adjustment process holding back consumption, then we had exports being weak, and then we had demonetization and GST. So August 2017 is the first month, I would say, is when you have the demand environment for exports and consumption both looking fine. And so we should just give it a few months. In our view, growth will really recover from here on, and we don't really need monetary policy to compromise right now on its target of inflation and overall real rate framework by cutting interest rates. Supriya.
All right, Jaggi, comment on that. Chetan believes that monetary policy has largely done its job. At best, there is sort of a window for a quarter of a percent rate cut, likely in the December policy, if at all. What's your view? Because you've obviously been very critical of the RBI and of its monetary policy action over the last 6 months.
Well, I differ slightly with Chetan Iyer, because I think monetary policy has not done its job. In fact, it hasn't been doing its job since February this year, when they suddenly shifted from an accommodative stance to neutral at a time when there was a huge amount of demand compression. It was obvious that the next few quarters are going to be very tough in terms of operating environment for everybody. So they actually should have done it much earlier, but what they have done is they have delayed it. If you are giving something, you might as well give it in the right time. So they have missed the bus repeatedly, and I think it's not done its job. And even now, while I agree with the general point that in itself a 25 basis points cut is not going to change the needle on growth substantially, but what is worth doing even if it's a bit late, and it's every little bit adds to the comfort of industry and other things to removal, and it's not going to make a huge amount of difference in terms of fiscal signals or inflation signals. Inflation actually is done by is problematic in the primary areas like food and fuel. So we have to look at that area which is entirely in government control, and the government can fix those two things more easily because they are directly amenable to supply and fiscal policy initiatives. That's why I feel the RBI should cut the rates, if possible by 50 basis points, and close the debate after that.
Okay, close the debate once and for all by actually doing a higher rate cut than what you will be expected to. But you know, many expect a pause, and Jahangir, I'm going to come to you on that. Many expect a pause because people believe inflation has inched up. Yes, it has gone to levels of 3.4% in August, but that's largely on account, like Jackie was pointing out there, on food and fuel both. And both of these commodities are actually outside of the purview of monetary policy, and shouldn't RBI in that case oblige with a rate cut? We'll discuss the quantum in just a bit, but I just want to understand from you, given that inflation reading is on account of food and fuel, why is there this, this sense, this fear that the RBI will pause? And is that pause unnecessary because this is not their purview really?
Let me respond in two ways. One is that, if you look at core inflation has started to pick up. Any kind of growth forecast, any kind of inflation forecast, let's say to first quarter of 2018, will suggest that headline inflation can easily be above 4%, which is the midpoint in the range. Therefore, it is very hard to see how in an inflation targeting framework, and again, in an inflation targeting framework, what has happened in the past matters very little. What really matters is what the RBI is looking forward to, and it's very hard to see 4% being substantially undershot. So that's the reason I think the scope for rate cuts is less. But I think there's a bigger issue here.
Okay, Chetan, I'm going to come to you, and another reason why we did a poll of market participants, of bankers and economists, and there was 100% consensus that they don't expect the central bank to cut rates. So while people may want a rate cut, no one's expecting it. But we're trying to see if there is a case. And if you were to read the CPI data of August in a more granular manner, you'd appreciate that it's largely been driven by three factors, like Supriya pointed out, which is fuel, vegetables, and fuel for vehicles, vegetables, and housing. And aside of these three factors, the rest of it, which contributes to 80% of the CPI basket in August, it's the same as it was in June at about 2.7%. And these three factors are largely driven by seasonal/global reasons. So fundamentally, it's not as if the inflation trajectory is again on its way up. So it's not as if structurally there are drivers for inflation up. So should the RBI then ignore the uptick in inflation and look at this as an opportunity to cut rates before it loses window over the next couple of months?
No, as I mentioned, we have to go from the causes of why the economy is in this shape and then arrive at the solution. So that would be the first approach one should take. Secondly, more specifically to Jagannath's point, irrespective of whatever is the macro circumstances and causes for the weak situation of the economy, monetary policy should do its job. But then let's take the outlook for inflation. Do you really believe that food inflation is where it is because of some structural shift in India's food inflation dynamic? The answer is no. Food inflation is relatively low because of a lot of confluence of cyclical factors. So we should assume that food inflation will come back to that 4.5% rate, and underlying core inflation is also around that 4.5%, which is where the RBI's comfort zone is. And if you take the policy rate where it is, calculate the real interest rates, we don't really have a significant amount of real rate buffer at a time when you are expecting the Fed to go in the other direction and begin to tighten. So I think more from all the dynamics of understanding what should monetary policy do, I as an independent economist don't feel that there is really much room for monetary policy here to help the economy.
Okay, as an economist, Chetan Aya and Jahangir Aziz don't believe there is too much headroom for monetary policy. I know Shobhana Kamineni and Jaggi differ on that. But I'm going to point out one other factor that must be weighing on the minds of policy makers, and I know it did for a while. The GST, and I know the RBI waited and wanted the GST to play out and then see what the impact will be. But largely the consensus, Jaggi, is that the GST has not been inflationary. I mean, it has had other effects. It has had supply side concerns. It has created a working capital acute pressure. We'll talk about that in just a bit. But the fact that the GST has not had inflationary concerns, and you know, setting aside concerns of the two economists on the show, does that add to the cause and argument for a rate cut?
Actually, the GST impact on the inflationary side has been a little more on services, especially financial services, and less on the goods and supply side, goods side and manufacturing side. So I think since services by and large we tend to ignore in the inflation calculus, so I think we should do that. More important, I think at this point we need to weigh two things. One is inflation the bigger concern or growth? It's very clear to me that growth is the bigger challenge and a much, much bigger challenge. And one of the reasons why we are having low growth is with all the signals being sent on black money, what is essentially happening is that black money has started reducing itself from the face of the economy. What this means is the velocity of black money has decreased, and money velocity, whether it's black or white, if it reduces, it will bring down the growth trajectory in any case. And this factor we need to take it into account when we talk about growth, and we need to look at ways to improve. That is why we are saying there must be some kind of a stimulus. It can be intelligently targeted, but you need a fiscal stimulus and a monetary measure that brings down rates is equal, and it will be monetary and fiscal will be in partnership here.
I'm sure Jahangir and Chetan fundamentally disagree with that point, but I know Shobhana for sure does agree with that point. CII has called for a fiscal and a monetary stimulus, but specifically on monetary stimulus, we've spoken a lot on fiscal stimulus and the sort of upside and downside of that move, but specifically on monetary stimulus, the RBI has sort of boxed itself into this, inflation targeting sort of regime. But even with that, there is elbow room. It's got a band that it looks at of 2 to 6%. Currently, CPI is well under the 4% band. So do you think the RBI used this opportunity to give itself leeway, because it still has some headroom? And like Jaggi pointed out, between inflation and growth, given where growth is, it's a sort of no-brainer on where the focus should lie of all policymakers, both at the government and in RBI.
So, first thing, I like the way you said box. This is the time to think out of the box. This is the time that I think that I didn't make it clear earlier, but 0.25 is not going to move the needle. We really need to say that and move out of conventional wisdom that says that you can't do it, that the Fed quantitative easing is becoming tougher for us to cut interest rates, all external factors, internal factors, but we need to move our economy. This is our economy, and I think 1% is something that really needs to be done. It's an out of the box, but it needs to be done now. It cannot be done in December. This is the time we need to kickstart the economy, and I think it's important for us. And if you see that if the way it looks short term, we need this for many reasons. You've gone through the litany of problems in terms of fiscal. So the monetary is where we really need to step in at this time. So I hope the Fed will react. I hope the RBI will react positively and not look at inflation and other economic indices. We really need to do something actionable at this point.
Okay, I'm going to take this across to Jahangir Aziz, and Jahangir, the CII, which, Shobhana Kamineni represents Indian industry, says it's time to think out of the box. Unconventional monetary thinking is the need of the hour, and that means, according to the CII, a 1 percentage point rate cut. There's a question on that, but there's a question also on inflation targeting. The whole idea of inflation targeting is to have a flexible band. And mind you, that flexible band is between 2 to 6%. Why are we fixated with just 4? And you can also criticize the RBI for wrongly reading the data successively. They overshot on the target because they read the data wrong. So the cost of inaction, many believe, is very, very huge right now. Jahangir.
Look, before we start thinking out of the box, we need to see inside the box first. So let's start looking at inside the box first. Almost everyone seems to be with a consensus view that the reason why we had a 5.7% print was because of a demand shock. Actually, there was no demand shock. The entire demand had recovered. The real problem was that the demonetization had disrupted supply chains, and so when the demand recovered, all of this was being fulfilled by imports and not by domestic production. So if you look at imports in this quarter, and if the imports had stayed at the previous quarter's level, then 5.7% would have been 8.7%. The rise in imports took away 300 basis points or 3 percentage points from growth. There is no real demand shock. So I'm sure there is in some place there is a theory which tells me that you need to respond to a massive supply shock that takes away 3 percentage points of GDP with a demand stimulus, but I really have very little sense of that theory.
You know, at this point,
Okay.
sorry, can I come?
Chetan, the whole idea and the whole... Okay, yes, sure. Shobana Kamineni, come in, because I'll give you a quick pointer. We have to take a quick reaction from Chetan Aya as well. Ms. Kamineni, please come in.
So just that conventional wisdom is really not going to cut it at this time, and all the economic debates, because if you see the medium and small term companies, they're struggling. If you want growth, if you want new capacities to start kicking up, this is the time that we have, we really need action on the ground. I can read you a litany of problems that we're currently in. And it's not the economics that's going to fix it, it's action on the ground of something bold and what we need to do. And if all of us know these actions of bringing interest rates down by 1%, and then also of the rupee, which is just too strong sitting there, that even the people that are producing for internally feel that this is not sustainable, and leave the exports in India, which have really reduced. You've said 2.4% is our deficit, revenue deficit. I think we really need to correct that at this point. Our current account deficit at 2.4% is unsustainable.
Okay, so while we will discuss out of the box versus in the box, the point that Jahangir made, and a spirited defense coming in from the CII, but Chetan, I want you to come in on the point that Jahangir made, that this isn't a demand side issue, this is a supply side concern. The GST has disrupted or has created a supply shock of that nature. If I were to go with that point, and the fact that there is an acute working capital pressure right now, it gives me all the more reason for the RBI to then cut rates and boost the short-term production. This will give immediate relief to that short-term production, because this is going to ease rates immediately. I mean, don't you agree with me on that? Because this isn't the demand side, this is supply side, there is all the more reason for action by the RBI.
No, I agree with Jahangir that this isn't a demand side problem, and demand has been recovering from April 2017. And it has been nearly normalized. I use two-wheeler sales as one indicator for discretionary consumption spending, and that has recovered quite nicely. And GST has caused some supply problems, but that is also getting normalized. We saw the PMI data for last month already ticking up. So we think that underlying demand problem has recovered, and supply issues will be more transitory. It will come back on its own. It is nothing to do with the monetary policy situation. The GST problem is not likely to be lasting for more than 2-3 more months. This is going to be another surprise to people, like demonetization was also quickly resolved in terms of its impact on the economy and demand. But Supriya, I also wanted to point out one other issue. We're making such a big issue about the GDP growth number, which has shown 5.7% number. But I would urge you guys to look at the broad corporate revenue growth, which goes back to the point which Jahangir made in terms of overall demand in the economy. Corporate revenue growth for June quarter has already been actually even slightly better than March quarter, and March quarter was significantly better than December quarter. And there has not been a big dip in the corporate revenue growth. So honestly, I think first of all, growth is not as bad as what GDP statistics are showing. Whatever problems we had because of demon and GST, worst of it is behind us. The bigger problem was at the margin that we had weaker export growth in 2015 and 16, which has cumulated to a weak overall growth environment, but that's turned around. By the way, today morning we got Korea's exports number. They're up 35% year on year in dollar value, on top of 17% growth in August. So we do think that the external demand is pretty strong, the global economy is strong, and India will get the benefit of that too. We don't really need to compromise on our monetary policy framework and use and do something out of the box on that front. We know we had a big problem on monetary policy framework in 2009 to 2014, right. Or rather 2013, when we had 5%, very low interest rates and 10% inflation. So I would stick to waiting for growth data to turn on its own with exports and better consumption.
It's all right to say that 25 basis points may not move the needle on private investment, and even we agree with that, and which is why I think CII is asking for a higher rate cut, may or may not happen. But what it will do is two things. A, sentiment, and we'll discuss that a little later with Shobhana Kamineni. But what this will certainly do is this will fuel retail demand, which in turn will perhaps exhaust the the excessive utilization or the excessive capacities that corporates are sitting on. Don't you think that's a virtuous cycle that will be put into motion, Jahangir?
Look, look at corporate investment. Corporate investment declined since 2010. You have seen household investment has been declining since 2012. We have had almost 125, 150 basis points of decline in lending rates. What has it done? Essentially nothing.
On sentiment, is it overrated? Because again, people believe one of the reasons to look at a rate cut is that it will change sentiment. The mood in corporate India is down, and no two ways about it. You speak to CEOs and people are not as bullish as they were, say, 6 months ago. Will 25 basis points really change the mood? Will the sentiment change with this cut?
25 basis points is not going to change the mood. But what we're talking about is the here and now. The here and now is the raging debate, and that needs actionable, that people will understand, that people can translate into something that will help me tomorrow. And I really like the fact that what the finance ministry is actually working on, improving the GST, the GSTN also, and cleaning up all those. So those are the things that have already started sending positive sentiments. But what we need is for the monetary policy to kick in. And this is the time, if they want to do it, and if they want to see sentiment on the sentiment among industry improve, we need to make some big bold moves. And CII has actually submitted almost 3 pages of we've socialized what we require in the short term, medium term, long term, and there's a series of things. But one of the most important short term is again 1% interest rate, and also the rupee needs to depreciate.
Here and now needs to be fixed. These are structural. Some of them are structural reforms that have been undertaken, and and the sort of downside of that has been far more than originally anticipated. So we need to fix the here and now. Or do you believe that we must not tinker with both the monetary policy framework and the macroeconomic stability in our bid to get the economy out of the hole? Is that conventional sort of macroeconomic thinking the needed there even now in this crisis situation, or is there a case for slightly unconventional economic thinking?
So first of all, I think to start with your last point, we are not in crisis. So growth is weak, understandably, but it's not something that we need to really respond with fiscal and monetary policy stimulus. I agree with Jahangir that we don't need to tinker both on either monetary policy or fiscal policy. But right now, at this point of time, we don't think that there should be anything done either on fiscal or monetary policy. But more importantly, as I mentioned earlier, we can explain why growth was weak until July 2017. We had something or the other going wrong, either externally or because of issues like demonetization and GST. So we just need to wait. And the first 2 years after 2013 was supposed to be weak because we had raised interest rates, we were tightening fiscal deficit. So look, this is the natural course of an economy which is coming out of adjustment. I would particularly wait for the next 2-3 months growth data point and then assume that, okay, things are really not working. We need to do something to revive growth. In my view, growth will actually surprise on the upside over the next 3-4 months to people. And then all these debate about trying to provide some extraordinary stimulus will go away. And I would urge not to, again, still rely on the GDP statistics to conclude as to what's happening here and now and at the near data point. You have the corporate sector, the companies are institutions like CII are speaking with. But you can also look at the broad corporate market aggregate revenue growth, which several institutions are compiling, and that is an independent data set. And it's not showing any serious collapse in growth like how GDP statistics are showing.
There is obviously this clamor for fiscal stimulus from the industry, and there is a whole narrative here. The New Delhi is perhaps even looking at one. The question really is, will the RBI let fiscal stimulus weigh on its mind? Will the MPC members, 6 of them, actually sit there when they decide on policy, think about the fiscal stimulus and its possible impact? Will this weigh on decision making?
I don't think they will weigh on the potential actions from the government. They will react to the actions that the government may take in future. And since the government has already indicated that the borrowing program is unchanged at this point of time, I don't think they will have for this meeting any reason to believe that the government will go on additional expansion on fiscal policy. But look, the state governments have already done that. Some of them have announced that farm loan waiver. So that has definitely weighed on RBI's mind, and we've heard that from RBI themselves. But I think one thing, Supriya, we should, while we are trying to find solutions to how to revive growth, not miss that one other important point, that rate cuts, whatever happened, as Jahangir mentioned, have not helped, and the reason is because of the NPL resolution not happening in the banking system. So the action that the government should take towards a quicker resolution to the banking system, and RBI is already working towards it, is what we should focus on. And I think that until that happens, transmission is not going to work, which even RBI has highlighted. So we shouldn't ignore that aspect. So we should look for solutions, but we can't just look for some solutions just for the heck of it because we think it may or may not work, but let's just do it. RBI is a responsible institution, and we shouldn't compromise on the monetary policy framework, which is just taking its route at this point of time.
Fair point. So what he's saying is that the monetary policy transmission will not happen as long as the NPA resolution doesn't get done, and so that needs to be fixed. And so otherwise, we can keep talking about 25 basis points cut or 50 basis points cut, but as long as the NPA resolution doesn't happen, we're not likely to see monetary policy transmission. How do you counter that, Shobna Kamineni?
So one of the things I've said is that this is the point of doing something out of the box, and it's not because we're in a crisis mode, or it's not because we don't believe in the medium term that 12 months from now our capacities will get exhausted. We'll start putting this together. But it's something what Jaggi said. I think that it's a question of the economy. It's the question of the belief in India. It's the question of the political economy also. And finally, it's all about creating jobs. Really the sentiment here is that we're not creating jobs. At the end of the day, if that doesn't happen, all this discussion is so academic, because we do have to get in there and actually do things that are going to stimulate more job creation in the country. And a lot of it will come from many of the things that are spoken about today. And today, of course, it's the subject of the moment is rate cut. It doesn't mean that we're not having discussions about the NPA resolution. It doesn't mean that we're not having discussions about GST and GSTN and DMON and all these other things, about infrastructure, fiscal deficit. All these discussions are going on. But today's discussion is really about the RBI and whether we need this, we need the interest rates to be cut. And I think that this will definitely help. This will create capacities. This will create, for all the good reasons that we've spoken about, and ultimately it boils down to the fact that we will create more jobs.
There are arguments on both sides, and I will agree partly with you and partly with the economists like Chetan and Jahangir. But Jaggi, I'm going to come to you. One of the things that is being said is, let's put aside the out and the inbox debate for a bit, but banks. Let's talk about banks, because they will eventually have to act on whatever the RBI does. Now, there is a broad fear that the banks themselves are under pressure to cut deposit rates, especially because deposits, if you see, largely are moving from CASA to the time-based models. I mean, given that, will a rate cut be helpful, or do you believe in some sense the banks will never pass it on, and so it will be an exercise in futility?
Actually, we are in an interesting stage where we have a fiscally influenced monetary policy, where the government, when the RBI does not act on rate cuts, is actually giving you interest rate subventions directly. Post demonetization, we have seen a large inflows into bank deposits, and that has enabled them to cut deposit rates and lending rates to some extent. So before demonetization, you had a situation where there was no transmission of any rate cut. The 170, 150 basis points cut, hardly less than half got transmitted. But now, even without the rate cut, rates are being transmitted. What the rate cut will do is indicate directionally that you need to cut, and it is a psychological booster. And I think that's going to happen whether the RBI does anything or not, because I think the government is determined to push rate cuts, and it will happen. So at some point, if the RBI does not act, the fiscal side will act to bring down rates. Like suppose you want to help exporters tomorrow, you can have another subvention scheme. If you want to help the SME sector, you can have yet another subvention scheme. Essentially, the government will push the rate cut down, whether it comes from the MPC or it has to be fiscally supported. That's what will happen. Right. If the RBI doesn't do this.
So what Jaggi is saying is that if there is no monetary stimulus, then that probably builds a stronger case for a fiscal stimulus. It has to happen one way or the other. That's Jaggi's view. Chetan, you want to comment on that? And I want to also add another question, which is, since you're not in favor of both fiscal and monetary stimulus, what about the currency? Do you think there's at least a case for the central bank to allow the rupee to depreciate a little bit, to offer some cushion to exporters? Is that some form of intervention that you are in favor of, Chetan?
Yeah, sure. Just going back to the monetary policy debate first, from what we heard that, we have to cut it right now, and monetary policy again has to do its job. Now, I would say that, okay, fine, if that is the solution, shouldn't we operate with some kind of a framework? Is any solution like, just cut it by 100 basis point is the approach to take? Then we have to think about what is the real rate in the situation, in the economy, what is the balance of saving and investment, which is represented by current account balance. And right now, it's not as if the current account is in surplus, either there is huge excess saving, and therefore we need to cut interest rates because that's what the economy is already telling you. Or similarly, from inflation perspective, as I mentioned to you earlier, can somebody confirm and tell me that 1.5% inflation in food will stay here for long? Is this actually a structural trend, or is it just cyclical trend which is now already reversing as we speak? And in 2-3 months time, we could be staring at food inflation going back to normal levels, headline inflation back to around 4.5. So real rates have already been down to the levels where they should be for this level of economic growth. So I really don't think that we can just have a random approach to this, that I think you should cut interest rates. We have to think about the framework and then present the solution. Now, as far as the rupee is concerned, the rupee is not really the solution again for exports. RBI has done enough studies to show that ultimately the explanatory variable for what happens to our exports is what happens to the end demand in the global economy. And as I was mentioning earlier, global economy is recovering. Exports for the region are already doing quite well. We should see the benefit of that as well. We've got some delay in that benefit realization because of the GST issue, and all those issues which are holding back the exporters in terms of the input tax credit. But that again should be getting resolved. It's a working capital issue, and 2-3 months time that gets resolved, you will see the export benefit coming back. I don't think really the rupee is a problem for our growth or exports growth trend.
Shobhana Kamanani, you want to counter that? Because I know your argument is that the currency is perhaps a little too strong for the comfort of exporters, and if it's not interest rate subvention, at least let there be more management to let the currency depreciate. But here's Chetan, who's saying there is a delay on realization, and eventually when the working capital requirements are met with for exporters, things will pick up. So let's not tinker with the rupee right now.
So fundamentally, I do agree that that we need to get over the working capital problems for the exporters, but this will happen but you will see that the stress in exports actually started before GST came in, and as the rupee was strengthening. So we do need to cool the rupee down, at least by 5%, because if you see, we're competing against this entire neighborhood, and the neighborhood, they're all growing. If you see Vietnam, Cambodia, Indonesia, Philippines, all of them are growing at 6+%, 7%, and most of them are export driven. Of course, China is coming back strong. So in this scenario, we have to say that, and of course, if you see a current account deficit, so this is the time when if you say that the world economy, and we know that the world economy is strengthening and we have an opportunity to export, I think we should fire up Indian industry and make it world competitive. So this is the time that we can gain. And of course, that's the time that we can increase capacities also. So I think that this is two-pronged. So to me, it has to come in that we need to cool the rupee a bit.
All right, closing comments from our panelists, and I'm going to come to you, Jaggi, first. And you've been a part of several of our fiscal, stimulus for growth debates here at ET now, and we've got varied views from the government as well. People like Rajiv Kumar have sort of called out, saying that there's a case for 50 basis point slippage in the fiscal deficit. And then we had Jayant Sinha last week on our channel, and he made a point. He's saying that yes, there's a need for stimulus, but it's not going to come. It should not come from the fiscal side. It should come from the monetary side. My big fear is, probably what's going to happen is that the government is going to expect the central bank to provide the stimulus, and the central bank is, unlikely to do that. So we might be in a situation where we don't get any stimulus. Do you see that happening at all, or do you think that lack of monetary action is going to put more pressure on the government to act on the fiscal front?
Yeah, actually, this pehle aap is not going to get us anywhere. I think the government probably has a stimulus plan in mind, but they are not revealing it because they want to see what the monetary side does, which will happen in the next 2-3 days. Once we know what the Reserve Bank and the MPC decide, then the government will act, because prematurely announcing the fiscal deficit, fiscal stimulus would mean that the Reserve Bank may hold back its hand. So they are probably waiting to see if the Reserve Bank does anything and then take their call, because the next monetary policy anyway is in December. So I think they will take the call in a little after the monetary policy date. And as far as the fiscal thing is concerned, I think priority obviously is to be the banks, the resolution part, and resolution automatically means an increase in fiscal deficit unless you are able to get to disinvestments so fast that you are able to cover up all the losses elsewhere. So I think you need to have a certain fiscal stimulus. How much is what we need to debate. That I think it should be greater or not lesser, and somebody can say it can be lesser. That's okay, that's reasonable debate. But I think the monetary stimulus needs to start first, and then a fiscal stimulus that's reasonable needs to follow.
Okay, you know what? I'm going to bring this focus back to the monetary policy, because that's under consideration. And Chetan Iyer, the last question is really coming your way. Have the last word on this. I understand from you that you have apprehensions and reservations about monetary easing right now. But what about stance? Can the stance continue to be neutral at a time like this? I mean, I know you believe there is no crisis, but there is softening of growth. And so can the stance continue to be neutral, or do you expect a more dovish or a change in stance at all?
I would say yes, the stance needs to be neutral. We need to wait for the next 3 months. I think we've hardened this progress that India has achieved over the last few years on macro stability. You are going to see recovery in growth, but if in next 3-4 months you again still don't see any sign of growth recovery, and again as measured by corporate revenue growth, not by CSO's GDP statistics, which we are skeptical of in terms of accuracy of telling you what's happening at the margin, then I would say that the RBI needs to reconsider. But I would wait for the next 3-4 months data for inflation and growth. In my view, inflation will tick up, and at the same time growth will tick up. So the pressure on the RBI to change the stance would not be there.
Jahangir Aziz, Chetan Iyer, R. Jagannathan and Shobna Kamineni, thank you so much for taking time out and joining us on this very important debate today before the Monetary Policy Committee meets to take a call on interest rates. Thanks so much for joining us here at ET Now.